All right, get ready to dive into the world of Forex.
It's going to be a wild ride.
Oh yeah, we're talking trillions of dollars traded every single day.
Every single day.
It's like this giant, never-ending online auction where countries are basically bidding on each other's money.
You got it.
And guess what? You can actually get in on the action too.
That's the best part.
So today, we're going to break it all down using a video we found called, hold on, let me get this title right. ¿Qué es el Forex 2024 en cómo funciona?
Catchy title.
I know, right? It's by a channel called Riqueza Vital.
They actually do a really good job of explaining the basics.
So first things first, what exactly is Forex? Why is everyone so obsessed with it?
Well, Forex stands for foreign exchange. It's the global marketplace where currencies are traded.
Okay, so I'm buying one currency and selling another.
Exactly. At the same time, always in pairs. Like if you're trading the euro against the US dollar, that's USD.
Okay, so it's like a constant tug of war between currencies.
Yeah, you could think of it that way. And those values are always fluctuating.
So it's like a global popularity contest for money.
I like that analogy. It really is all about which currency is in higher demand at any given moment.
Makes sense. But who's actually making these trades happen? Who's connecting the buyers and sellers?
That's where brokers come in. They're your intermediaries in the Forex market, like the real estate agents of the currency world.
Okay, so they provide the platform and the tools you need to participate.
Right. They connect you to the market.
Got it. So what makes these currencies go up and down in value? What are the driving forces?
Well, one of the biggest factors is interest rates. Imagine you're an investor, you want to put your money where it's going to grow the most, right?
Makes sense. Higher interest rates, bigger return.
Exactly. So countries with higher interest rates tend to attract more foreign investment, and that increased demand pushes the value of their currency up.
Okay, so strong economies with high interest rates usually have stronger currencies.
Generally speaking, yes, but there's another big piece of the puzzle, inflation.
Inflation, right? That's when prices keep going up.
Yep. And if a country has high inflation, their currency is going to lose purchasing power compared to other currencies.
So it's like their money is worth less on the global stage.
Exactly. So low inflation is good for a country's currency. It makes it more attractive to hold.
Okay, so interest rates and inflation. Got it. What about the role of governments in all of this? Do they have any influence on currency values?
Oh, absolutely. Governments and their central banks are major players in the Forex game. They use something called monetary policy to influence their currency's value.
What does that look like?
Think adjusting interest rates, controlling the money supply, even directly intervening in the market to buy or sell their own currency.
Wow, so they can really manipulate the value of their currency.
They can, and they do. It can get pretty strategic. And then there's political stability.
Okay, so politics comes into play too.
Big time. Countries with stable political environments tend to attract more foreign investment, which boosts demand for their currency.
So basically, political instability can scare investors away, which can weaken a currency.
Yeah, if investors are worried about a country's political future, they're less likely to invest there, which can hurt the currency.
So it's not just about the numbers, it's about confidence in a country's stability.
Confidence is key. Investors need to feel like their money is safe.
That makes sense. So we've talked about some of the big forces that drive currency movements, interest rates, inflation, government policies, and political stability. But how do traders actually analyze all of this information and make decisions about buying and selling?
That's where we get into the two main approaches to Forex analysis: technical analysis and fundamental analysis.
Okay, break it down for me. What's the difference?
With technical analysis, traders are basically studying charts and looking for patterns and trends.
So it's all about those squiggly lines on the graphs.
Yep. Technical analysts use tools like moving averages to try to predict future price movements based on past price data.
Okay, so it's kind of like trying to predict the weather by looking at historical weather patterns.
That's a good analogy. Of course, the market is much more complex than the weather, but the idea is similar. You're looking for clues in the past to try to anticipate what might happen in the future.
And what about fundamental analysis? What do those traders focus on?
Fundamental analysis is all about understanding the underlying economic and political factors that drive currency movements. So they're digging into economic reports, news events, government policies, anything that could impact the value of a currency.
So technical analysis is all about charts and patterns, and fundamental analysis is about understanding the bigger picture, the underlying forces that are at play.
You got it.
That makes sense. I can see how both approaches would be valuable. But before we dive deeper into these strategies, I'm curious about the history of Forex. How did this global marketplace even come to be?
Well, the exchange of currencies has been around for centuries, even going back to ancient bartering systems.
So people have always been trading things of value.
Absolutely. But the modern Forex market as we know it really emerged after World War II.
What happened after the war that led to this?
Well, the world was in chaos. There was a real need to stabilize global currencies and get international trade back on track.
So they needed some kind of system.
Exactly. And in 1944, a bunch of countries got together at this historic conference in Bretton Woods, New Hampshire. They came up with a system that pegged most currencies to the US dollar, which at that time was backed by gold.
So the US dollar was like the anchor for the global financial system.
Yeah, you could say that. It was like the gold standard, but with the dollar as the central currency.
Okay, so how did that system evolve into the Forex market we have today?
Well, the Bretton Woods system worked for a while, but it eventually collapsed in 1971. The US dollar was under a lot of pressure, and the gold standard couldn't be sustained.
So what happened then?
We entered the era of floating exchange rates. That means currencies are valued based on supply and demand. They're constantly fluctuating in this global marketplace.
So that's how we ended up with this dynamic 247 Forex market.
Exactly. It's a constantly evolving, ever-changing system.
Wow. From a post-war agreement to a global trading phenomenon, the evolution of Forex is pretty incredible.
It really is. And along the way, there have been some major events that have shaped the Forex landscape as we know it.
Oh, I bet. Give me some examples. What are some of the key events that have really rocked the Forex world?
Well, one that stands out is the Plaza Accord of 1985. This was a meeting of the finance ministers of the US, Japan, West Germany, France, and the UK.
Big players.
Yes. And they made a pretty bold move. They decided to intentionally weaken the US dollar.
Wait, they purposely devalued their own currency? Why would they do that?
It was all about trade imbalances. The strong US dollar was making American exports expensive, which was hurting their competitiveness. So they decided to take action to bring the dollar down and boost their exports.
So it was a strategic move to protect their own economic interests.
Exactly. And it had a significant impact on the Forex market. Another event that shook things up was the Mexican peso crisis of 1994.
What happened there?
Well, Mexico's currency, the peso, crashed. And it wasn't just bad for Mexico.
Oh, I bet it had a ripple effect.
It did. It sent shockwaves through global financial markets, highlighting just how interconnected the world economy is.
Wow. So one country's currency crisis can impact everyone.
Absolutely. And then there's the Asian financial crisis of 1997-98. It started in Thailand and spread rapidly across Southeast Asia.
I've heard about that. Wasn't it pretty devastating?
It was. It showed just how volatile emerging markets can be and the risks associated with currency speculation.
So these are just a few examples of how real-world events can completely disrupt the Forex landscape.
Exactly. It's a dynamic market that's constantly being shaped by global events.
Okay, we've talked about events, but who are the major players in this global currency game? Who are the big movers and shakers?
Well, you've got a diverse cast of characters, each with their own motives and strategies. Central banks, for instance, are like the referees.
Okay, so they're trying to keep the game fair.
In a way, yes, they use monetary policy to try to maintain stability in their own currency, but they also have a big impact on the overall Forex market.
So they can manipulate things to their advantage.
They definitely have a lot of influence. Then you've got the big commercial banks. They're the heavy hitters, facilitating huge transactions for clients and managing their own currency portfolios.
So they're the ones making the big trades?
They're a driving force in the market for sure. And then you've got multinational corporations.
Right. Companies that do business all over the world.
Exactly. They're constantly exchanging currencies to pay suppliers, receive payments. It's all part of doing business internationally.
So they're just doing what they have to do to operate globally.
Yep. And let's not forget about investment funds.
Hedge funds and that sort of thing.
Right. They're always looking for opportunities to profit from currency fluctuations. They add another layer of complexity to the market.
So we've got central banks, big banks, corporations, investment funds, all these major players battling it out in the Forex arena. But what about regular people like me? Can anyone get involved in Forex trading?
Absolutely. That's one of the things that makes Forex so exciting. Online platforms have made it accessible to anyone with an internet connection.
Wow, so I can actually trade currencies from my laptop.
Yep. You can be a player in the Forex market too.
That's incredible. I always thought it was just for the big guys, the Wall Street types.
Yeah.
But are there different ways to approach Forex trading? I mean, it can't just be random buying and selling, right?
Oh, definitely not. There are lots of different strategies and approaches. Let's start by talking about four distinct trading styles: scalping, day trading, swing trading, and position trading.
Okay, I'm ready to learn. What's scalping?
Scalping is all about speed. Scalpers try to make small profits from very rapid price fluctuations.
So they're in and out of trades very quickly.
Exactly. They might hold a position for just a few minutes or even seconds.
Wow, that sounds intense. What about day trading?
Day traders, as the name suggests, confine their trades to a single trading day. They close out all their positions before the market closes.
So they're not holding any positions overnight.
Right. They want to avoid the risk of the market moving against them while they're sleeping.
Okay, makes sense. What's swing trading?
Swing traders try to capture profits from price swings that last a bit longer, maybe a few days or even weeks.
So they're looking for those bigger market swings.
Yep. They're not as concerned with the tiny intraday fluctuations. They're looking for those more substantial price movements.
Okay, what about position trading? What are those traders like?
Position traders are the long-term investors of the Forex world. They might hold positions for weeks, months, or even years.
Wow, so they're really playing the long game.
They are. They believe in fundamental analysis and are betting on major trends unfolding over time.
So there's a trading style for everyone.
There really is. It depends on your personality, your risk tolerance, and how much time you're willing to dedicate to trading.
This is fascinating, but I'm curious. With all these players and strategies, what tools do people actually use to navigate the Forex world? It seems like you'd need some serious technology to keep up.
You're absolutely right. There are all sorts of platforms and tools that traders rely on to analyze the markets, execute trades, and manage their risk. It's a whole other world of Forex tech.
Welcome back to our Forex deep dive. Last time we really unpacked the basics, what Forex is, who's involved, all the different trading styles out there. But let's get real for a second. Trading, it always involves risk, right?
Absolutely. And Forex, no exception.
Okay, so Forex Risk Management 101. What are some of the major risks that traders face?
Well, first and foremost, there's just the market itself.
Market risk.
Yeah, prices can swing wildly. Even seasoned traders can get caught off guard. Remember, we're talking about global forces at play here.
That's true. You've got economic news, political events, natural disasters. So many things can impact currency values. So how can traders protect themselves from those unexpected market swings?
One of your best defenses: a stop-loss order.
A stop-loss order.
Yep, think of it like a safety net. You preset an order that automatically closes your position if the price drops to a certain level.
So it limits your potential losses.
Exactly. It takes the emotion out of trading, too. You're not panicking, making rash decisions when the market moves against you.
That's smart. Okay, what about leverage risk? We talked about how leverage can amplify your wins and your losses. How can traders manage that effectively?
Well, the key is to be responsible. Never use more leverage than you can comfortably afford to lose.
Makes sense.
And always have a clear risk management plan. It's easy to get caught up in the potential for profits, but you got to be prepared for losses too.
So it's like anything else in life, don't bite off more than you can chew.
Yeah, exactly. Don't get in over your head.
Okay, good advice. What other risks should traders be aware of?
Another one is liquidity risk. Imagine you're trying to sell a currency, but there aren't enough buyers at the price you want.
So you're stuck.
Yeah, that's liquidity risk. And it's more common in less traded currency pairs.
So sticking to the major currencies is a good way to minimize that risk.
Right. The more liquid a currency pair is, the easier it is to enter and exit trades quickly and efficiently.
Got it. What about interest rate risk? How does that play into Forex trading?
Well, interest rates are a big deal in Forex. They can really impact those currency values. Let's say a country's central bank suddenly decides to hike interest rates.
Out of the blue?
Yeah, that can attract foreign investment, strengthen their currency. On the flip side, if they lower rates, the currency could weaken.
So basically, you need to keep an eye on what central banks are doing.
Absolutely. Monitoring interest rate decisions and economic indicators, it's crucial for understanding those underlying forces that drive currency movements.
Makes sense. Any other risks we should be aware of?
Well, we can't forget about political risk.
Mm.
Politics it can be just as volatile as the financial markets.
Oh, yeah, absolutely.
Unexpected events like elections, policy changes, or geopolitical tensions, they can really send currencies on a roller coaster ride.
So basically, staying up to date on global news is part of a Forex trader's homework.
It definitely is. Being aware of those political developments and how they could potentially impact currencies can give you an edge.
Okay, so to recap, managing risk in Forex, it's about being aware of market volatility, using those stop-loss orders wisely, being cautious with leverage, and then understanding liquidity risk interest rate risk, keeping an eye on political developments. Anything else I missed?
I think you got it all. And remember, continuous education and prudent risk management, they're your two best weapons in the Forex arena.
All right, risk management, check. Now let's talk about something a little more exciting. We briefly touched on this before, but I'd love to hear more about the stories of Forex legends. Those traders who made fortunes in this market.
Oh, you want to hear about the rock stars of Forex?
Exactly. Their stories are so fascinating. It's incredible to think people have actually made billions just by trading currencies.
There are tons of inspiring stories. Let's focus on three captivating examples. George Soros, Bruce Kovner, and Paul Tudor Jones. Each one achieved incredible success, but in totally different ways.
Okay, let's start with George Soros. His name is practically synonymous with Forex trading. What's his claim to fame?
Well, he's a legend for his audacious bet against the British pound back in 1992. Soros, he believed that the UK wouldn't be able to maintain its currency peg within that European exchange rate mechanism.
Yeah.
And he was right.
So he basically went head-to-head with the Bank of England.
He did, and won. Big time. When the UK was forced to withdraw from the ERM, the pound plummeted. Soros reportedly made over $1 billion in a single day.
Wow. No wonder he's known as the man who broke the Bank of England. What a story. Okay, what about Bruce Kovner? What's his strategy?
Bruce Kovner, he's a master of discipline and fundamental analysis. He didn't come from a wealthy background. He started with just a few $1,000s and built a massive fortune through meticulous research and analysis.
So he's proof that you don't need a ton of money to succeed in Forex. It's more about having the right skills and mindset.
Exactly. Kovner went on to found Caxton Associates, one of the most successful hedge funds in the world. He's a legend, known for his deep understanding of global economics and, of course, his commitment to risk management.
Incredible. Okay, last but not least, tell me about Paul Tudor Jones. What makes him a Forex legend?
Paul Tudor Jones, he's famous for predicting and profiting from the 1987 stock market crash, Black Monday. He used this combination of technical analysis, historical patterns, and, his gut feeling to anticipate that market's dramatic downturn.
So he saw the warning signs that everyone else missed.
He did, and it paid off, big time. While a lot of traders were suffering heavy losses during that crash, Jones actually made a fortune. He's a testament to the power of combining that technical analysis with a good, intuitive understanding of market psychology.
Wow, these stories are so inspiring. They show that with the right knowledge, skills, and mindset, it really is possible to achieve incredible success in Forex.
Absolutely. But it's important to remember that these are exceptional cases. Most traders, they don't become billionaires overnight. But these legends, despite their different approaches, they all share some key traits. Discipline, deep understanding of the markets, and a relentless focus on managing risk.
So it's not just about luck. It takes hard work, dedication, and a willingness to constantly learn and adapt. Right. What's so fascinating to me is that even though we're talking about, technology, global finance, it's still very much a human endeavor.
Absolutely. Trading, it's as much about understanding yourself, your strengths, your weaknesses, your risk tolerance, as it is about understanding those markets.
This has been such an insightful journey so far. We've explored the mechanics of Forex, we've delved into risk management, even met some legendary traders who've conquered this market. But there's still one key element we need to explore: the tools and platforms that empower traders to navigate the Forex world.
You're talking about the technology that makes it all possible.
Exactly. In the next part of our deep dive, we'll explore the platforms, indicators, and other tools that can help you analyze the market, execute trades, and manage your risk. Get ready for a deep dive into Forex tech. Welcome back to our Forex deep dive. We've covered so much ground already. The inner workings of Forex, the risks, different strategies, even those inspiring stories of legendary traders.
Right. Those are some incredible journeys.
They were. But now, it's time to talk tech. What kind of tools and platforms can people actually use to trade in the Forex market?
Let's open up that Forex toolbox, see what's inside.
Okay, I'm ready. Let's geek out a little bit. We talked about MetaTrader and CTrader earlier. Can you remind me what makes these platforms so popular?
Sure. MetaTrader 4 and 5, or MT4 and MT5 as you'll often hear them called, are kind of the industry standard for Forex trading.
Okay, so what makes them so special?
Well, they come loaded with all these advanced charting tools, tons of technical indicators, and even the ability to automate your trading with something called expert advisors.
Wait, hold on, back up. Automated trading? Like, I could set up a program to trade for me.
That's the idea, but it's a little more complicated than that. Expert advisors, or EAs, they're essentially programs that you can either create yourself or download,
Oh, okay.
and they execute trades automatically, but based on a set of rules that you define.
So it's like having a little Forex robot working for you 24/7.
In a way, yes, but you still have to understand the strategies behind those EAs, right? You need to know what you're doing and use them responsibly.
Right, they're not a magic bullet.
Definitely not.
Okay, MetaTrader, so it's pretty powerful stuff.
It is.
What about CTrader then? What makes that one stand out?
C-Trader. It's known for its speed and that user-friendly interface. It's really popular with, like, scalpers and day traders who need those super fast executions. They want a clean, uncluttered trading environment.
So if MetaTrader is like the Swiss Army knife of Forex, CTrader is more like that high-performance sports car.
That's a great analogy.
I like that. Okay, and we also talked about TradingView earlier. What's its role in the Forex world?
TradingView, it's an amazing resource, especially if you're into technical analysis. It's got these really beautiful interactive charts,
Oh, yeah, they're nice.
a huge library of indicators, and a whole community of traders where you can, like, share ideas and strategies. It's kind of like a social network for Forex enthusiasts.
I love that. I love the idea of connecting with other traders and kind of getting different perspectives on the market. That's really cool. But with all those charts, indicators, data points, how do you even begin to make sense of it all? It seems pretty overwhelming.
That's where technical indicators come in. Those indicators are like mathematical formulas that can help you identify trends, patterns, potential buy or sell signals.
Okay, so like a cheat sheet for the market.
Sort of, yeah. They can help you decipher those charts.
Can you give me some examples of like common indicators that Forex traders use?
One of the most popular ones is the moving average. It's a simple but effective way to smooth out those price fluctuations and just visualize the overall trend of a currency pair.
So you're not getting bogged down in those like daily ups and downs.
Right, you're seeing the bigger picture. It's like looking at a map instead of getting lost in the details of every street corner.
Makes sense.
What else? Then you have Bollinger Bands. They're a little more advanced. They measure that market volatility and can signal potential breakouts or reversals.
So like when a currency is about to make a big move.
Exactly. Bollinger Bands can be really helpful for identifying those moments, finding good entry or exit points for your trades.
Okay, so moving averages and Bollinger Bands. Got it. What other indicators should I know about?
Another important one is the Relative Strength Index, or RSI. It's a momentum indicator, basically tells you whether a currency is overbought or oversold.
So it's kind of like a temperature gauge for the market?
Yeah, exactly.
Okay, and what about MESID?
The Moving Average Convergence Divergence, or MESID, it's another popular momentum indicator. It helps you identify those shifts in strength, direction, the momentum of a trend. It's a bit more complex than the RSI, but it can give you that more nuanced view of what's happening in the market.
Wow, so there's like a whole science to technical analysis?
There really is. It takes time to learn and master those indicators, but the good news, there are tons of resources out there to help you along the way.
This deep dive has been amazing. We've covered the inner workings of Forex, the risks, strategies, the technology. I'm starting to feel like I could actually trade in the Forex market.
That's the spirit. Remember, continuous learning is key.
Absolutely. So as we wrap up this incredible Forex journey, I want to leave our listeners with one final thought.
I'm listening.
Knowing what you know now about Forex, the opportunities, the risks, the tools, the strategies, what would your Forex journey look like?
That's a great question. Would you be that scalper, chasing quick profits with rapid trades? Or maybe a swing trader, riding those waves of market swings? Or perhaps you'd prefer a long-term approach, a position trader, betting on those major trends?
So many possibilities.
Exactly. There's no right or wrong answer here. The best approach is the one that aligns with you, your personality, your risk tolerance, your goals.
I love that. So to all our listeners out there, keep exploring the world of Forex. Dig deeper into the resources we mentioned. Practice on those demo accounts. And if you're feeling bold, take the leap and start trading.
It's an exciting world out there, full of opportunities and challenges. Who knows, you might be the next Forex success story.
That's it for our Forex Deep Dive. We hope you've enjoyed the journey and gained some valuable insights into the fascinating world of currency trading. Until next time, happy trading.